Good afternoon and welcome to Fund Advisor Live. For those of you joining us for the first time, this is our monthly conversation where we pick one topic that matters to your portfolio right now and spend an hour on it. No filler, no market commentary. Uh, you have already read three, from last Advisor Live to now. You have read three of my mails, which is advisor note, which I send every Saturday morning. Today's you would have received it already. So today's topic is international funds, and this is the topic most Indians are struggling with. Too many things have happened ever since it became possible to invest in these funds very easily, and many investors have been wanting to invest. And the good news is that there were glitches, and that math has changed. It has become favorable. The tax code has changed how they are treated, and some of the funds are actually open to invest in because there is also a ceiling for mutual fund that to the extent they can invest abroad, and they all breached that. And now some of the funds are actually facing a situation that that makes them eligible to invest. So some options are open. Ashutosh is here with me. Between us, we will give you specific funds, specific allocation, and a clear sense of what to do if you choose to invest abroad and choose to invest in international fund. What should you do on Monday morning? Before we get into this main topic today, let me spend 2 minutes on one thing I want every new subscriber to hear at least once. We are getting large number of new subscribers all the time, and I would like them to really take note of what have you subscribed. Five questions most investors do not have you would have read it on the landing page by subscribing it, that most Indian investors do not have a fund problem. They have an advice problem. They either have too many funds or they just invested without much of a plan. And advice that is not really advice, because every transaction the person in front, just in case you are investing, because most of us nowadays we start investing through a fintech, through a broker, through a easy mechanism, because KYC has become easy. Your online bank account is accessible. So if you choose to invest, the process of investing has become easy. But where you should invest, is it a suitable one or not? We just get started instead of actually stepping back and thinking that where are we investing, why are we investing, and that results in too many funds, sometimes without a plan. And sometimes if you have a bank relationship manager or a distributor who is helping you, because every transaction the person in front of you recommends, he earns commission quietly, daily, and for as long as you hold that fund. Fund advisor is the fix for that, because you will always know exactly what to do with your mutual fund portfolio, what to keep, what to drop, and what to buy next. This is the job. This is what you have hired us for. You have subscribed to Fund Advisor and you have hired me, Ashutosh, and everybody who works in the fund team to help you do this. Because we very well understand that investing in mutual fund is fairly democratized. You can invest through any mechanism. But if you want to invest with confidence, with understanding, in a manner that will uh, you will not go you will not be confused on occasion. You know your course. So every feature in the service exists to answer one of the five real questions which every investor generally is asking most of the time. Let me run you through them. The first thing, which I meet so many people socially, and people think that I'm some great expert, and I'm still learning. So I can tell you that the most important thing, which everybody is curious to know, that how are my investments doing, and you bring in everything you own. Fund advisor helps you aggregate everything together, whether it be in your demat account, CDSL and NSTL, or CAMS or K fintechs consolidated account statement, which is mandatory. We help you fetch it, and setting up your portfolio has become very easy, aggregating it. So we are able to give you a diagnosis which is uh, what is working, what is not, and what is the accident that has crept into your portfolio. You invested in a fund which was doing exceptionally well, and it is not doing well. So is it really a reason to worry, or is it really a bad situation to be in, and you should get rid of it? This is something which we you're bringing objectivity in your investment decisions, and which has a long-term impact on your financial health. Then comes, is anything urgent? Every fund you own gets a verdict from us, and we are fine tuning it. Next fund advisor session, by that, then hopefully we will be giving you a much larger audience, because right now, many of you have told us in the last 2, 3 sessions that there are many funds which are on which we don't have opinion. We are trying to, so we will still not have opinion, but we are working on the methodology. We have revised it, and the outcome is brilliant. I will just give you a curtain raiser to what we are up to. All the funds which are less than 1 year old still will not have an opinion, but all other funds we will be able to give you a provisional opinion. Just in case you have invested in a thematic fund or a sector fund, we normally will not be recommending you to invest in those, because we think that the primary benefit of investing in a mutual fund is diversification, and that you are able to derive instantaneously the moment you invest in a mutual fund. But just in case you have it, it may not be a very dangerous thing. It may just might fit in very nicely in your overall portfolio. So that will be a portfolio specific suggestion to you based on your context. So we will get back to you in greater detail. So the portfolio review mechanism is undergoing a change, and that is what will be factored. So you will have a more wholesome opinion on a larger part of your portfolio. Many of the things which we don't recommend, but it is perfectly fine in your portfolio, we will be suggesting you. Besides that, specific fund, what is the cost that you have incurred, because we don't want you to drive to action unnecessarily. At the same, so we are just conscious of all that, and this is all a result of all this thinking which is getting factored in the interface, is result of the thousands of mail which we get from you, and all your expectations, all your demands, all your questions has contributed to devising this mechanism. So let your questions keep coming. Then comes, as I was telling you, that is anything urgent? Every fund you get a verdict. Besides that, most people have this very basic question: where should I invest? Sometimes you are onto a steady plan, but you get a bonus. You have sold some house, or you just got some money, or you got some bonanza from your parents. Where to invest that money? How do you structure it? A handful of funds we would put our own money in across equity, hybrid, or debt, very much based on the time frame, risk tolerance, and you get these recommendations with great objectivity. Then investing for a goal, a retirement, child's education, a down payment in 7 years. You tell us the goal, and we give you the portfolio, and it is very much conscious. It is all these interfaces, all the things that you see. It looks like the machine is doing it. Not really. Real people are curating the list which populates the eventual recommendation. And then the most important, because every other day, this is such a noisy place. Market is full of noise, and the environment, the economic environment is also full of activity. Most of the time it crosses our mind that we need to, and we are taught from our childhood that if you have to succeed, you have to work hard. So we just extend that to our investments too, that we should be do what should I do right now with our investments? And most of the time, as I keep writing you, and most often I'm very repetitive, and I don't get tired of repeating this, that on most occasions you do have to do nothing. Uh, so, but just in case, there are things happening around which causes great anxiety, and for this you get the weekly advisor's note from me on Saturday morning, and this monthly session where we get an opportunity to understand your anxiety firsthand, listen to your questions firsthand, not listen to, read your questions firsthand, and try our best to answer those. So, what makes our advice different? One last thing, because it matters. The most valuable advisor, to our understanding, that is how we have defined ourselves, that we will just to pretend that we are working very hard for you. We will not drive you to do something for the heck of it. So the most valuable advisor is the one who can tell you to do nothing when the right move is to do nothing and stay on the course. And we will say that, we will keep reminding you. That sounds simple, but it is not. It is one thing that somebody who has incentive to impress you with his activity or his suggestion, and he has his revenue dependent on that. It's almost impossible to say so. Also, we will not drive you towards any complex thing. We will try to simplify things. I would like to have our recommendations and reviews and all the opinion in such a manner that if it requires any kind of it will take you effort to really absorb it. We haven't simplified enough, and that is where our entire energy will be invested. So we can say that because of our only revenue is that the subscription fee that we get. We have no interest in complicating it and simplifying it and asserting our value just because we have complicated things, or we have taken you to in something which looks very sophisticated, but it is expensive. We have none of those ulterior motives, and we have no sharing arrangement. This is it's a registered investment advisor with SEBI, and we can't earn any money here in this business. So between our income and your outcome, that is the entire service, and most of the recommendations that you get, most of the views that you get, it is all configured. The spirit of the service is something that is how I will actually be telling it to my auntie or my uncle or my parents, most importantly my mother-in-law, uh, so that you don't have an embarrassing situation, and you should be able to face that with your head held high. And because the moment you have this much of clarity uh, uh, of what we have set out to do, and that I think is the most important thing. So now so this is the shape of what we do. Now let me get on to the reason why we are here on a Saturday afternoon. And thank you for being here. International fund. You know exactly how much of your equity portfolio should sit outside India and why. You will know which international funds are open to fresh rupee today, because most funds were closed for, they were not taking money. They had hit the ceiling. And you will know what Ashutosh and I would, put our money in right now. And just as important, what we would not touch, what we would leave alone. And you will also know why the tax argument against international fund, which was fair for years, no longer applies. It has become reasonably equitable market. So no vagueness, specific allocation, specific fund names. So why don't you get started, Ashutosh, with 4.5% portfolio? That's the first headline that you come up with.
Sure. So thank you, Dhiren, for setting that wonderful context. And hello, everyone. 4.5%. I'd like you to absorb that number. And this is the salient idea. This is the most important number we'd like to anchor this session on. And the idea is that if you only own Indian equity funds, your portfolio is a bet on just about 4.5% of the world's listed businesses. So think of it this way, that if the entire listed universe across the globe is worth rupees 100, India is just 4.5 rupees out of that. And if you and I, as investors, have only invested in those Indian listed businesses, then we are betting on only these, on some companies, some businesses out of this 4.5% universe only. Now, if you consciously took that decision that the rest of the 95.5% is not worth owning, then I think you need to think again. But in our experience, that is not a conscious decision that any investor has taken. It has just happened. It has just evolved that way. It is how you've just ended up accidentally building your portfolio. But I think now is the idea to change and look beyond this 4.5% universe. And there are tailwinds. The tax code, which used to be very punishing until 2024, has changed. And overall, if you look at it, then yes, now there are a lot of reasons why you should look beyond just the Indian universe. Specifically, let me give you 5 reasons, and let's run quickly through them. Number one is the access. If we look at how the global businesses are progressing, well, the businesses that are building artificial intelligence, semiconductors, cloud infrastructure, global platforms, the businesses of the next decade, most of them are not listed in India. We do not have an NVIDIA. We do not have a TSMC. We do not have a Microsoft for that matter. Uh, and if you look at the central idea of investing in equity, at its core, it is about long term ownership of great businesses. And if the great businesses of the next 20, 25 years are listed somewhere else, then you need to own some of them. So that's point number one, access to the businesses of the future. Second is about country risk. And if you look at it overall, 19th March was when the Indian markets crashed severely. India was India was not, and India is not a part of the US-Iran war, but our portfolios suffered anyways. Sensex fell 3.26% in a single session. That's about 10 lakh crore of wealth wiped off. And apart, if you look beyond, there have been lots of businesses across the globe which have been on the other side of the war. Defense, energy, logistics. These are the kind of businesses that were making money while Indian businesses and the portfolios centered on Indian listed universe were suffering. And these businesses are not listed in India. And mostly none of our mutual funds hold them. So the idea is that you can be hit by a war you are not in, and you cannot own the businesses that profited from it. Uh, and the surprise is not that this happens. The surprise is how many Indian investors have portfolios that cannot respond to it at all. So look beyond India to eliminate the country risk in your portfolio. Third is the correlation, and this is more statistical. Uh, India's correlation with the US market is just about zero point 0.5. That is relatively low correlation, and it simply means that the two markets do not move in tandem, they do not move together. But on the contrary, India's correlation with emerging markets is pretty high, about 0.88% to 0.9, 0.88 to zero point 0.9. We are talking about countries like Brazil, China, South Africa, and that is high. They tend to crash together. So the true diversification that you should reach for, that you should yearn for, is about looking at the developed world, the US markets. That is where most of the diversification really lies. The fourth point is about the rupee. And this is quite quiet and steady, and probably something that most people don't even talk about. Uh, the long term secular trend suggests that rupee has weakened against the dollar in every single decade since independence. On an average, the rupee slides against the dollar by about 3 to 4% a year. And that's the kind of return, that's the kind of extra return tailwind that you can get by investing abroad, by investing in the US markets, by investing in dollar terms. Now, on a standalone basis, this should not be a reason to invest abroad. This should not be a reason to invest abroad. But if you're measuring the opportunity cost of not investing abroad, you should know that you're leaving, something very easily on the table. And the fifth and the final point is about the historical record, whereby a portfolio with even 15 to 20% allocation sitting outside India in international markets delivers better risk-adjusted returns than having a portfolio 100% in the Indian markets. And this is not because the international markets always beat the Indian markets. In fact, most of the time the reverse may be true. But that's because when the Indian markets crash, the worst year for India is not the worst year for the world. The worst year may not be for the US. And the difference in those two worst years is where the diversification benefit lives. So, for overall better risk adjusted outcomes on your portfolio, international investing makes sense. Now, the next point is about the tax tailwind and why, and the only objection to international investing which remained till about the 2024 has now been removed. So, until 2024, the gains on the international fund of funds were taxed at your slab rate. So, if you fall in the 30% tax bracket, all the gains that you made on your international investing were put to tax at 30%, while your domestic equity investments were taxed at 12.5%. And that was a huge gap. That was large enough that even a defensible diversification case was hard to win on a pure post tax basis. But that punitive gap is gone. Now, even the international funds are taxed at par with the Indian funds at 12.5%. Yes, the holding period tends to be longer if you are holding a fund of fund structure. So, to qualify for the long term capital gains, you have to hold your international funds for 2 years. But that's the whole idea of investing in equity. 2 years is not a long term, really, if you look at your equity investing. So, with the tax disadvantage gone, international investing case only gets stronger. So, Dhiren, would you like to talk about the broad thumb of rules around how much to allocate to international equity?
There is no rule of thumb. I would say that I would like to give you the principles which I will be guided by in the long term. The reason for investing in equity is very simple. One should be investing one's long-term money. And investing in equity is always about investing for the long run and investing for capital appreciation. And when it comes to investing for the long run and investing for capital appreciation, one's entire focus should be investing in the finest businesses. And there are multiple ways of achieving it. Mr. Buffett does it by choosing those companies himself and holding it for 10 years, 20 years, 50 years. We simple people try and reduce our risk by investing in a mutual fund. We start with our SIP, and carefully chosen 3-4 fund is good enough. But when it comes to this new option which is now available to us, that earlier we could invest only in India, now we can invest anywhere. Our option goes up. And today, as it is only 4.5%, I have now the whole canvas to paint, to build a portfolio or look for companies, but I may not have the bandwidth. I may not have the ability to understand those businesses. Familiarity with the business, ability to understand. So a mutual fund comes in handy. I would say that, is there a rule? Is there a percentage? Is there a thumb rule that you should have no more than 20%? You should have no more than 40%? No. Of your equity investment, which is the money for the long run, you should have good businesses, whether they happen to be in India or whether they happen to be anywhere. Now it comes that how comfortable you are with this whole framework and how simple it is for you to execute. I would say that somebody getting started should not even consider this. Your first 5,000, 10,000 rupee SIP, while you're trying to make yourself familiar with the market, invest in a fund which also invests abroad. And there are 8-10 funds where you invest in that domestic fund and you get the foreign exposure. Once you are crossing that basic threshold and you want to be deliberate about it, maybe 10%, 20%, 25%, 30% is not very serious. And I think it could well be a substantial part of your portfolio as and when you get very comfortable, as and when you understand that it is an equity exposure, and your dharma of investing in equity is because when you invest in equity through a mutual fund or through stocks, your only religion is be in the finest companies with the best suited to your temperament, not get into questionable things. And if you are able to find it anywhere in the world, that is it. But then anywhere in the world, it's very difficult to exercise with. Mutual funds are able to give you a vehicle where a degree of curation, a history, a track record, a regulatory oversight, your ability to ensure, your ability to be reassured that nobody is taking money and doing whatever he wants to with the money, that will not be the case. So I would say that keep it simple. You're up to first 25,000 rupees SIP, you look for the fund which also invests abroad. Once you cross that threshold, then maybe anywhere from 20 to 40% could be an acceptable thing. There is no rule. There is no basis to frame a rule that it has to be this much percentage?
So now comes to the point about which funds. Having talked about the case for international investing, uh, well, the first thing, the most preferred international allocation for us tends to be Nasdaq 100. So if I could put a rupee into international fund today, the first choice would be the Nasdaq 100 feeder fund. Now, not because we have some great insight into the future that Nasdaq 100 is destined to outperform, but because among the indices available to an Indian investor, it is the one that most cleanly reflects the businesses shaping the next decade.
This is the
Semiconductors,
opportunity. Yeah, the
absolutely.
most opportunistic thing.
Semiconductors, cloud infrastructure, artificial intelligence, global platforms, all the big themes that we talk about the next 2 decades, you can find a fair allocation and diversity in Nasdaq 100. And this is where the future innovation lives. And it is the exposure you cannot build through Indian equities. So, you get to participate in the businesses of the future and the businesses which you don't get in India anyway. So that leads to true diversification. So that is the one which we would pick. But the problem here is that none of the Nasdaq 100 funds listed in India are open for fresh subscription right now. The RBI places a cap on how much Indian mutual funds can collectively invest overseas, and all the Nasdaq focused funds have hit that cap. So there are about 9 of them, including the ETFs. Uh, Most of them has hit their caps. None of them are accepting fresh investments. One or two of them are allowing to continue any existing SIPs, but for most others, even existing SIPs, they've stopped taking fresh investments. Now, ETFs have their own limitation. While you can continue to invest in a Nasdaq 100 based ETF, you can buy the units on a stock exchange, but the problem is they trade at a premium. Over the last 1 year, if you look at the trend, every Nasdaq 100 focused ETF has traded at a premium on an average of 5-7%, and that keeps spiking. When the demand suddenly shoots up, that is like buying something whose MRP is rupees 100 at rupees 107, at rupees 110. So you are paying extra amount more than the worth of the underlying portfolio, and that is something not very desirable. So in a nutshell, Nasdaq 100, despite being a preferred route, is
Not an option.
is not an option for in the mutual fund construct for Indian investors. So what's available actually, you ask? Well, to filter down, to narrow down on the funds which you should consider today, we have three main filters. One, for obvious reasons, the fund has to be open. The fund has to be open for fresh lump sum investments and SIP investments. If it is closed, it is not a candidate, no matter how good. The second is that the mandate, the investment mandate has of the fund has to be broad and global. Not a China fund, not a Latin America fund, not a commodities fund, not a real estate in one country fund, a diversified global or a developed markets mandate. And really, that's the whole point of international exposure, that you are not picking a specific bet. Third is that it should not be trading at a premium for the reasons that I just explained, and the limiting factor that I just explained regarding the Nasdaq 100 ETFs. So it is the demand and supply mismatch between these ETFs, where the demand is really high, but the supply is limited to the quantity of units trading on the stock exchanges, which causes their NAVs to almost constantly remain at a premium to the underlying NAV of these funds. So open, global, and no premium. Those are the three filters that have been important while shortlisting the funds that we are recommending to you today. So now, the main agenda of this session: four funds, the four international funds that we have on our radar for you. First is the Access Global Equity Alpha Fund of Fund. Now, this is a feeder fund. This invests into the Schroeder Global Equity Alpha Fund. which is a fairly big fund. It's a $5 billion global equity fund with about 52 stocks in its portfolio, benchmarked to MSCI World Index. Now, if you look at our list of four funds, this would come across as the most conservative of the four. Uh, it also has relatively lower NASDAQ overlap. Now, the numbers that you see on your screen are the NASDAQ overlap that we've put for the top 10 holdings, because we are constrained by how much these funds disclose of their total portfolio. But Nasdaq being our preferred, list of
Reference for us.
businesses, so this gives you an indication of how much overlap by investing in these, how much of a proxy Nasdaq exposure you will get. Uh, so this is relatively more conservative. It has the broadest sector spread, more diversified than some of the other funds on this list. It has reasonably good exposure to healthcare and financial services over and above technology. And you can think of this fund as your steady, diversified global core. Annualized returns in the last 3 years have been about 23.5%. And just to put that number in context, during this time period of the last 3 years, our domestic Indian markets, the BSE 500 index, has returned about 16%. So while Indian markets have not done as well in the last 1.5 years, and that reflects in the 3-year returns, that's where the diversification with international investing would have helped in these last 3 years. The next fund on our radar is the Axis Global Innovation Fund of Fund. This invests in another Schroders fund, the Schroder Global Innovation Fund. Earlier, it used to be called the Global Disruption Fund. So, if in case that name,
the context of this.
Yeah. And among all the funds on our list, this is relatively more concentrated, bet on innovation themes. It has 76 holdings, but almost half of the portfolio is in information technology. It beyond US, it also gives you the meaningful exposure to Taiwan and China. The next two, kind of as far as the way the world is progressing, two hubs of innovation, Taiwan and China, companies like TSMC, CATL, you get exposures to them. 3-year returns ballpark, by and large in the same range of about 23.8%. So that's the other fund you can consider. The third on our list is the Kotak Global Innovation Fund of Fund. This fund invests in the Wellington Global Innovation Fund. It is a relatively small fund, just about $195 million. Small portfolio, 43 holdings, and the size lends it the flexibility to be more concentrated, and it is the most concentrated of the four on our list. The top 10 alone account for more than half of the portfolio. And here you get a good exposure to stocks like Alphabet, Nvidia, Microsoft, TSMC, and about 12% exposure beyond the developed markets in the emerging markets. So, and the NASDAQ overlap here is 28%. So that's the third one you can consider. And finally, the fourth one, which is not exactly a global fund, but a more US focused fund, which is the Franklin India Feeder Franklin US Opportunities Fund. The underlying fund here is the Franklin US Opportunities Fund, and this has been running since 2000. Interestingly, this fund has had the same fund manager for nearly 2 decades. Grant Bowers is the name of the fund manager who's been running this strategy for the past 2 decades and doing a reasonably good job. Now, this fund focuses on the fast-growing, innovative US companies, and on our list, this has the maximum overlap with NASDAQ 100. So top 10 holdings alone have about more than 40% overlap with NASDAQ 100. So if you've been inclined and keen and a fan of NASDAQ 100 kind of businesses, then maybe this is the fund that should appeal to you the most. Names like Nvidia, Apple, Alphabet, Amazon, you get a plenty of exposure on these. And the 3-year returns about 25 odd percent. So yes, this is the closest thing to a NASDAQ substitute you can get that is actually open.
Ashutosh, it's about time, because I'm just looking at the questions people are asking, and a lot of people are asking about the gift city route.
Yes.
Why don't you explain? So Would you like this to summarize anything?
Sure. So, the natural extension to the argument of international investing is why not gift city funds? Now we have outbound gift city funds. There are about, 4 or 5 of them which are already operational. And to provide the context, gift city funds are the vehicles, to invest abroad, which are based out of Gujarat's IFSC, the International Financial Services Center, and they allow.
Ashutosh, just hold your thought. I just want to interrupt you
Sure.
for something which is in this context itself. And because I was looking at some of these questions, a lot of people are asking that is the return in is dollar denominated, or what is the currency denomination and all that. I would just explain you the structure of this. The way to invest, all the options that we have listed are domiciled in India. You have these funds which are you have these domestic funds which are regulated by SEBI, and many of these funds and these funds are permitted to invest abroad. Most of these funds either invest directly in those stocks, or they invest in a fund which invest which is meeting your objective. So all the 4 funds that we have listed, they were fund of fund. You give your money to the Kotak fund or the Axis fund or the Franklin fund, and that fund is investing in another fund. And the NAV is calculated in rupee. You invest in from your rupee account. Your money gets, and it is available, and through all the platforms whenever they are open, you can invest like any normal Indian mutual fund, and your money get invested. The investment that is made by the fund, that is in the other denomination, that is in the different currency, and that is dependent on the market in which it is invested in. So your NAV is calculated every day like a domestic fund in Indian rupees, and investing in them is easy. And when it comes to gift city, mind you, we are talking of gift city, and Ashutosh will take you through the detail. But the minimum investment is 4.5 lakh rupees, and first step in investing through gift city vehicles, which are still evolving, is that you have to convert your rupee into dollar to invest in those. That's an important step.
Yeah. So the good part about Gift City is, one is they are open. They lend themselves to investment, unlike many of the mutual fund vehicles that invest overseas that we just talked about. The limitation of the RBI cap that does not apply to Gift City, and they are open to investment. But that's the attractive part about them. The downside or the less attractive part is that they have a very large ticket size, about 5,000 US dollars that are needed, which is typically the threshold size to invest in them. That's about roughly 5 lakh rupees. So it is not a very monthly SIP friendly structure. They do not offer SIP scheme of things, which is the staple for equity investing, which we highly advocate for. Then the second idea is that operationally investing in them is not as smooth, efficient, and investor friendly as it is for mutual funds, where for all practical purposes you can invest in just 1 or 2 clicks. A lot of process is still physical. You need a separate account, you need a separate KYC, and there are lots of frictions. IFSC in Gujarat itself is evolving. It's a relatively new setup. On the global financial centers rankings, it still ranks 46th, which suggests that while it is upcoming, it's geared up. It can be a very promising avenue for us some years down the line. But for now, given that ecosystem is still evolving, we believe that mutual funds is still a far more convenient and a far more investor friendly avenue.
No, but hold your opinion. Let me just tell you the context of this, because I think we have missed out on explaining one thing. Investing for all Indian investors, investing abroad through Gift City or investing directly in any foreign market is very much possible. All Indian citizens gets an annual allowance of $250,000, which is quite a meaningful sum today. And any member of your family, everybody gets that. So $250,000 worth of investments can be made. Now, if you make it through Gift City, there is an extra layer of what do we say? regulatory oversight, better control, better reassurance. So that is your annual limit of investment. And these gift city options are coming because this is also very tax efficient. If you invest in the foreign markets yourself directly, there are state duties, state taxes, and then if you can well open your account for this $250,000 entitlement of investment abroad annually with any foreign broker. Move your money from your domestic bank account, convert it into that denomination, the dollar or whatever account, and then start investing directly. It is eminently possible. The only risk that you are taking is that there won't be any vetting involved. If that broker in Europe goes bankrupt, you don't know where to go. Here, the gift city would have done the essential checks and balances to make sure, and the money moving in and out through gift city will also be more tax efficient, and it is saving you from the applicable taxes and the treatment of that. For example, investing for Indians abroad, and particularly in the US, you are liable for estate taxes. That is something which I would like to escape. I would like to get out of. I would like to keep away myself from that. Or when I invest through a domestic fund, all the options that we listed here, that is even simple. I don't have to convert my rupee into dollar to invest in those funds. In Gift City, you have to understand the mechanics. This is a 250,000 maximum annual investment that can be made, and that has to be converted into that denomination. And then you choose the limited vehicle which is domiciled in Gift City. That is your option, and they are relatively new and evolving. Our view on Gift City primarily is that they are almost like an NFO.
Yeah. So would you just like to conclude the discussion, Dhiren, so that we quickly move to the investor Q&A?
Yeah. So I think that was the summary. Let me just one idea. I open with that. If you have your portfolio of 100% Indian equity, and no, I would also like to point to one question which I saw while reading these questions, scrolling here, is that somebody was asking that he has restricted stock units. He would have got stock options. He works in a company which is domiciled elsewhere, and should he consider his restricted stock units as his foreign exposure? Yes, by all means, but it is not a very meaningful diversification. The reason is that normally your stock option is a concentrated investment, and it is a very risky investment. If all your investment is that, because the day you lose your job is also generally going to be the day when the stock value will be substantially lower. If not it gets completely wiped out. So I would say that think of it as a international exposure, but don't think of it as a long-term diversified, deliberate exposure to perform. So
Great.
one last time I would say that the business shaping the next decades are mostly not listed in India. You need to have meaningful exposure to well-performing, most promising businesses, and some of these portfolios will give you access to that. These four are very simple. You can just use fund advisor to start your SIP or do your one-time investment. I would suggest that even if you have to make some one-time investment, please do that. Do it in an accelerated way. Though you are permitted to do your SIPs, but because these are restricted supply of units, the moment they hit a ceiling, they will shut the door. So why not invest while it's open? And not businesses, not because India will underperform. We have to think of it like my money needs to be invested, which is going to be the most promising investment. Indian businesses, you are getting exposure, and our jobs are here, our assets are here, and all our investments are here. Meaningful diversification comes here. Invest abroad. A lot of people are saying that why not invest? Why don't we suggest index and all? For the same reason, they are not open options right now, and the ETFs which are open, they are available at a significant premium. In fact, I would like to personally warn you that don't invest in the international ETFs, because some of these ETFs are available at 30-40% premium. If RBI opens the gates tomorrow to invest abroad more, this will disappear overnight. And it is almost like buying something worth 100 rupees for 140 rupees or 130 rupees or 125 rupees. Will you ever do it for a mutual fund? No. So let's get started with the questions and have more exposure to elsewhere because we are only 4.5%. That's the context.
So this first question comes from Mr. Pradeep Sonavane, and this is also the same question asked by Mr. Madan Chopra. They say, why are international funds not rated and also not in the analyst choice? Well, international funds are not rated simply because as a category, this is a very heterogeneous bunch of funds. Ratings work when you are comparing like for like. For instance, all the flexi cap funds, all the mid cap funds, or the small cap funds, they are very similar in nature and context, and that's why they can be put together in a category and rated, on a relative scale to find which one on a risk adjusted basis is doing better than the other, and that is the whole context of the rating. But with international funds, it is not like for like, because in the entire category you have funds having completely different mandates, so it's inappropriate to rate them together as a set. Going forward, I mean, if we get funds or threshold funds which are of a similar kind, tracking the same index, which can be compared like for like, we can consider hiving them off as a separate subcategory within international and rate them. But till that happens, the ratings will not work meaningfully, and they would not give you the right kind of input that rating is supposed to provide. That's why they are not rated, and they are not a part of analyst choice at this point, simply because of the reason that international investing has been a bit of a stopgap right now.
Fairly
Because
erratic, yeah.
yeah, funds open up, once if they experience outflows and the RBI limits, they get some flexibility because of some outflows, and then in a few months time they might put the gates back up. So they it's not a continuum, as Dhiren said, it's a little bit erratic. Sometimes they are available, sometimes they are not. The list that we've given you today are the ones which are open and we find them investment worthy, but maybe 3 months down the line, some of them might stop accepting new inflows. So for the lack of continuity that these funds lend today, we have avoided placing them in the analyst choice, and that's the whole purpose of doing this Saturday session on international funds. So even though they're not a part of analyst choice, we can at least provide you with the list of the funds which look good for investing today. This next question is from Ayush. He says, from a 20-year perspective, how much percentage allocation should go to international funds? So, well, as Dhiren, you just mentioned that there is no specific thumb of rule.
There is no rule. And start investing, and start with target 10% in 1 year, take it to 20%. And it's a meaningful diversification. It can well be 50% of your portfolio because your goal is to invest in great businesses, and you should be diversified at all times. And if as you gain confidence, then steadily keep increasing it. I don't think there is any rule which should guide that how much it should be. If we had some kind of magic wand that we knew that which market is going to do well and we can perfectly time it, then it could well be 100% in some fund or the other which is likely to do well. But it's almost impossible to do that. So what we are left with is diversify across geography. With domestic funds, we are able to diversify well across all the sectors, all the segments. With proper asset allocation, you are able to diversify risk of a specific asset class, which is the equity market. And now you have easy option of investing abroad. You are able to spread your risk and ride performance. And the case for international investing is so strong that some of the great businesses are unlikely to be only centered in India. We are unlike, and also Indian market is extremely promising. We are still growing, but growing at a frantic pace, the opportunistic component of the market is not necessarily in India, and that is the reason why you should invest. Start increasing it gradually. Keep it very simple. Make sure that you are not getting into unnecessary complicated stuff of opening a brokerage account, buying the stock, trying chasing ideas, and not implementing the portfolio rules, which every investor should ensure that either you have the time and inclination and ability to do it on your own, or you have entrusted your money to a fund to do it. Some people are asking here, which I would like to clarify, that what is the expense ratio of the funds? Yes, they are all operating in the expense framework of SEBI for fund of fund. And some of these numbers which you are asking from us, just look at the fact, the fund page on these funds, and you will find it on Value Research Fund Advisor details page itself.
Yeah. So this next question is from Piyush Pradhan. He says, is it okay to have both access funds mentioned by you, as one is alpha and one is innovation? Well, I'll be tempted to advise against. And the reason is that for both of them, the underlying funds, although they are two different funds, but they are from the same fund family, the Schroders fund family. And uh, typically, when we talk about the way we talk about domestic funds, that if you are wanting to build a portfolio of 2 to 3 funds, it is advisable to diversify across AMCs, pick good funds across different fund houses. Here, since the underlying both the funds are from the Schroders fund family, and if you want to go for the alpha fund, from this fund family, which is the Axis Global Equity Alpha FOF, then look at the other two innovation funds, or maybe the Franklin fund, because the alpha fund has relatively less overlap with the Nasdaq, while the Franklin feeder would provide you the maximum overlap with Nasdaq. So if you must look at two variables, then look beyond from the same fund family. Next question is from Mary Pauline. Is an international fund kind of investment suitable for retirees?
Yeah, for any person in his retirement is investing in equity, international fund is a very desirable option because it also spreads your risk. And hopefully the kind of vehicles that we, or the kind of funds we are choosing or we are suggesting, it delivers you the performance or we are very optimistic about those performance from most of these. And they're very easy way to, the way you invest in domestic funds, the access has become simpler. So yes, by all means consider. There is one question, and I think I have seen quite a few questions of this kind where uh, will we be tracking SIF? Yes, we are tracking it and it is available in the portfolio tracker. All SIFs are relatively new. The moment some of them, they have traveled for 1 year, we will have very clear opinion on SIF as well. For first 1 year, we don't have enough basis to give you any meaningful opinion, and we don't want to pretend to be giving opinion while it is baseless. So move to the next question.
So this next question is from Deepak Murarka. And I think this is something you've touched upon in your columns, Dhiren, earlier as well. So this one goes, Warren Buffett is sitting on more than 20% cash and the US markets are too expensive. Why are we suggesting international funds now when India is one of the fastest growing economies of the world and likely to do better than the US?
To diversify and performance. Warren Buffett is, he has all the money and he can afford to underperform. In fact, we admire Warren Buffett. We owe a lot of our investment understanding and wisdom. We appreciate, greatly admire his wisdom. And but 2-3 things which we should keep in mind. The vehicle which Buffett has chosen to make all his investment for his lifetime, that money remains with him forever. He does not have to really go and prove to anyone that this is my 1 year return, this is my 3 year return. Also, don't forget that Warren Buffett has generated a return of something like 10-11%, and last 10-15 years he has not beaten the benchmark there. Of course, last 40 years he has done exceedingly well. So do we have that time horizon? And we are looking at, and unfortunately, we don't have access to Warren Buffett, Berkshire Hathaway, and he has now never given a dividend. If you look at the face value, you'll figure out, the key stock, not the B class. So I'm saying that, yes, his view might be different. They can actually be very patient for a different reason. They have different kind of needs. For us, we are looking at opportunity, looking at meaningful diversification, and gaining exposure which is complementary to improve the performance of my overall portfolio. So he can time it. We can't. You can actually do it with your asset allocation. In fact, if you look at your portfolio overall, you might be sitting on 40% fixed income. Reason is that all of us, we don't even consider our provident fund as we don't consider it as our overall liquid investment. But when we look at it from a financial net worth point of view, all of us might be very conservative. If you work for the government, all your provident fund accumulation will be in fixed, will be invested in fixed income, will be yielding fixed income. So imagine most Indians have remained substantially invested in fixed income, and a small part of opportunistic allocation gets into only now in the last 5, 7, 10 years. We are witnessing that this trend towards gaining equity exposure through mutual fund by way of SIP, and the latest number is that little over 32,000 crore is moving into equity funds every month by way of SIP.
A couple of our viewers are asking, is it not a better option to invest in international funds directly through international brokers than taking the mutual fund route?
Yes, very much so. But even while investing, it is entirely a matter of convenience. If you are comfortable moving your money from your bank to the broker, convert that money and invest in that, you are at least getting one layer of regulated entity, that diversification, and many of those funds might be available. Exactly, and there might be some merit in doing that. But you have to bother about these exposure and the way it gets reported. The convenience that you get from investing in a fund which is domiciled in India is that you move your rupee, you invest like any other fund, and of course the choices are limited, and we are constrained here. So you get into that mode of that framework, 250,000 annual limit, move, convert your rupee into dollar. You can invest. You have to invest through one bank account only, and that I think will be the second best or the third best, because once we have these gift city vehicles evolve, they mature, and participating in them becomes easy. Then I think these will be the third best option. But as of now, they are the second best option, because gift city vehicles are not very routinized as of now.
Mr. Naresh Singh says, can we invest in international funds through your app? Yes, absolutely so. So the mutual funds which are open to subscription, the mechanics of investing in them is practically exactly the same as you invest in any domestic fund. So the ones which are open, you invest in them with absolutely the same way as you do in any other.
I have got a bad news and small alert here, which I would like to tell you. That Ram is writing here that looks like Axis Global Innovation Fund of Fund direct growth is closed, as my application yesterday could not be processed. So I'm so sorry for this. You anticipated our move and you invested, and the gates are closed. So one of the four, if it is true, we will reconfirm. And but looks like that's the reality. And so one of the four options that we have listed, which is Axis Global Innovation Fund of Fund, that is shut now.
No, Mr. Ram, we would request you to just drop us a note at advisor@valueresearch.in. We will explore what could have been the underlying reason why your application could not get processed, whether it was indeed about this or there is some other reason. So just drop us a one line.
Most of these options are on the verge of a boundary. They are actually hitting the ceiling or close to that. So as I was suggesting earlier, that some of these options may not be open forever for you to set up your long-term SIP and be at it. So maybe might as well, if you have spare money or reallocation possible, then consider investing while they're open.
Yeah. Then a lot of people are asking, can we consider multi-asset funds which have global equity exposure? Well, the idea is that if the objective is to get international equity exposure really, then with multi-asset funds, the ones that do, you will get very little of it. So, for a lot of money that you are investing, the international component that you will end up adding to your portfolio would still be very limited. And not all multi-asset funds are cast in the same stone. In fact, it is a very diverse set of funds with very different allocations. Some also invest substantially in commodities. Some even have some exposures to real estate. So multi-asset is a very diverse and a very different kind of set. And if your objective really is to add international equity, then multi-asset is not really the most optimal way to add international equity to your portfolio. So the funds that we recommend would still be better off. You'll be better off to add that layer of diversification. uh, then this next question is, how can one find on VR Advisor if a fund or ETF is accepting investment and still investing directly in the international market? Well, one way to do it is that the funds which are not accepting the investment functionality, when you try to transact in them or you click on the invest, that remains frozen, because the way the mechanics work is that every day we get the scheme masters from the underlying transaction platforms that are managed by BSC Star platform. And all the funds which have shut their gates, the investment is not accepted
The
on
button
them.
will be switched
And
off.
yeah, this is an evolving thing. Every day things can change. So that itself gives you the guide that this fund is no longer investing. And that's why I was curious to know, when Mr. Ram said that the investment indeed went through but it was restricted. We'll figure that out once you drop us a note, and we'll take note of it. uh, this next question is from Mr. Amish. He says, please compare and contrast the mutual fund route with gift city route as well, breadth of products. So, I mean, we just covered that a little bit. Well,
Yeah, that was the whole discussion
Yeah.
initially. And as the gift city route is evolving, the options are not mature enough. The investment mechanism is still settling down. The way you invest in domestic equity funds, or domestic mutual fund, or domestic stock, investing through gift city vehicle is completely different. First, you open a brokerage account or some investment account with a gift city entity, which is permitted to sell those investments, through in which those investments will be made. So it is a whole new process, and it is still evolving. And though domestic fund companies are also opening their offices and they're still trying to evolve that process, I don't know it is going to be as simple and seamless as it is for domestic mutual fund. Gift city vehicles will come. You can invest up to $250,000 annually. The minimum investment has to be $5,000. That is the minimum denomination, and that itself makes it a very large ticket, investment for a per person or per transaction basis. So, and we are watchful. We are looking at the options that are evolving, which are easy to invest, and they have not matured to a point that if you decide to invest, can you invest in 15 minutes the way you do in a domestic fund? It's not ready yet.
Mr. Rajay says, with mutual fund AMCs based in India, does an international fund completely rule out country risk in case of war or the other sovereign events? Is the international exposure not likely to be impacted? Uh, well, the idea is that that's a completely different type of risk you are referencing to, because when it comes to the underlying holdings, the businesses, if something catastrophic is happening in our country, and a certain portion of your money is invested in businesses which are not directly impacted by that, so to that extent, the country risk does not really arise. And the other thing is that in the entire construct, the way the mutual fund is configured, what happens with a mutual fund company is really, you can be shielded because your investments lie within a trust and there is an AMC. These are two different entities. We've had in the past where fund companies have shut, fund companies have exited from India, but the underlying schemes, the funds that they have been managing on your behalf have continued, and they have been relatively insulated from whatever is happening in the AMCs, whether it is profitable, whether it is undergoing some kind of a financial difficulty. The investors' money is insulated by design and by structure. So rest assured that what happens to the AMC does not directly may have a big implication on your money. So hope that answers your concern. This next question is from Mr. Devashish Neogi. He says, how much international exposure is there in Parag Parikh FlexiCap and SBI Focused? Well, conventionally, when the Parag Parikh FlexiCap fund started off, in its original mandate, it had a mandate to invest about a third of its portfolio.
35%. It could well go up to.
Yeah, that was the kind of range that they had for international investing. It was true to label, it was investing that much. But because of these caps and subsequently an incremental flows that have kept coming into the fund, but its inability to invest abroad because of the limits. Right now, Parag Parikh Flexi Cap would have about 10.5% of its total portfolio invested in international markets at the end of March 2026, which is the latest portfolio, while SBI focused has about 12.5% invested abroad. So
It will be
somebody
coming down as more people invest,
Yeah.
because it got frozen and it can't invest more. So when the day it got frozen, it was close to 31 or 32%.
Yeah.
After that, more Indian investors have invested money, and that money cannot be invested abroad in proportion. So gradually it has come down to 10%, and it will keep coming down if it keeps getting more money.
So Karthik says, given that the Motilal Nasdaq 100 ETF is trading at 20% more than its INAV, that's a real-time NAV, what should we do with current investment, sell or wait or hold? Well, your Nasdaq 100, one is that that's a happy situation that you own a fund which is trading at a premium, and while there are others who want to invest, but because of the premium they are constrained. So by all means, this is your long-term allocation. You have exposure to some of the finest businesses configured to possibly be multi-baggers from here over the next decades. So don't just trade these units out because of a very tactical advantage of 20% premium that you are getting right now. Hold them. This is your long-term strategic allocation. It is hard to get by with the current constraints put by RBI, so stay invested.
I would like to take this question because this looks like a related question. The hidden fees of fund of fund, these international fund of fund. There is no hidden fee. They are very transparent about it. Just take a closer look at what is the cost of the fund of fund layer and what is the cost of the underlying funds, and it is mandated by the law to be transparent. He's also asking that second, gold also correlates with USD. I wrote a note 3 weeks back on gold. Please look at it. I have written in great detail what is the case for gold, how much should you have it, and to what extent you should go. So read that carefully. It is lying in your accounts advisor's note, I think three weeks back. And you have access to it. And I've crafted that view very and tried to articulate it for ease of understanding. And it is not that we have at Value Research we don't suggest gold. We just think that gold should be looked differently, and that is what I have explained there.
Mr. JJ George says Nasdaq is at an all-time high. Is it worth investing in it now through Gift City? And he further asks, is Parag Parikh IFS in Nasdaq 100 Fund of Fund open for investment? So the short answer to your second question is yes. Parag Parikh Nasdaq 100 Fund is available. Although, as we just said, the mechanics of investment would not be as straightforward as in case of a domestic mutual fund. You'll have to, in Parag Parikh case, I understand that you need to fill up an application form with all the supporting documents that they require and drop your application to the nearest CAMS service center. And that is how, your investment can get initiated. Your folio would be created and then you can transfer the money and, the unit allotment will happen. But yes, that fund is open. Your broader question about, investing in a Nasdaq when it is at an all-time high, well, yes. I mean, when you look at investing for the next 10, 15, 20 years, then I don't know how many all-time highs, Nasdaq, or for that matter, look at it, how it has been, how the story has been in the Indian markets closer home. If, a Nifty or a Sensex sitting all-time high would have been a deterrent for any Indian investor from investing in the Indian equities, then they could have been deprived of the great bull run that Indian markets have witnessed and the kind of wealth creation that has happened here in the last 10, 15 years. So be disciplined about it, invest regularly, invest for the long term, and don't worry too much about the index hitting an all-time high. Would you like to add any dimension to that, Dhiren?
Yeah, in fact, when it comes to investing in fixed income, or when you think of deposits, there is never, it is always at an all-time high. If a fixed deposit yields 5%, then you're always buying at a higher price. The only In equity, the opportunity comes because of intermittent decline, because markets gets crazy every other day, or every few months, or every sometimes for years. And but let me tell you that this Nasdaq bit, or when we are talking of the US exposure, the way the world has changed, and because the stock equity investing has turned out to be a story of chasing growth. And chasing growth does not necessarily mean chasing stock prices. I'm saying earnings growth. When I'm looking at this Magnificent Seven as part of Nasdaq 100 or FAN Plus, uh, they are unusual businesses, and they are concentrated in the US. The whole world is their customer. They just might be domiciled in the US, and you might get a feel of concentrated exposure. But when you are actually buying, I really wonder that Alphabet is a US company by its domicile, where it is listed. But when it comes to its services, I think it's a globally diverse business. Or the way AI is making inroads into our lives today, effectively all the consumers of these, what do you say, the underlying services, or the services flowing from those companies, what Nvidia does is bought by these 5 7 companies, and everybody is going to be a customer of those businesses. So they are global businesses by their customer. They are concentrated businesses in the US by their domicile. And it is important that some of these high growth, unusual businesses, where the winner takes it all rule applies, uh, you should have this exposure. And if you have this exposure, and because they are a very high growth, little bit of apprehension about their outlook or change in outlook, that makes you wonder, and that is why they become extremely volatile. Some of these, in fact, when you look at the FAN Plus, the concentrated index of top 10 technology stocks in the US, they it's very usual for this index to be, on any normal day, it is plus minus 2% is a very usual thing. uh, in our case, if for domestic funds, for our kind of, we don't have these kind of high octane, high beta avenues. So they are high performance, and they are extremely volatile. They are so democratized, and they are so large. And I don't think they are even orchestrated, because the broad basing of their investor base have led to, and the institutional ownership, and the changing outlook, and the integration of the market. I don't know what happens, but I am basically banking on one belief, that a company makes profit, prices follow. And these companies are making enormous profit, and price will sustain, unless some of these companies, and they will come with their ups and downs. There will be phases in the I remember, 15 years ago, when it became possible for Indians to invest abroad, I was very apprehensive about this company, Microsoft, whereby Google was taking over. Looked like Microsoft has lost the plot, and it did for a while. But then it made a comeback, and what a comeback it has been. Likewise, we are all talking of Apple, and the whole invention of Apple iPhone, which led to the whole surge. Before that, it was close to its bankruptcy, or not, if not bankruptcy, it was on the verge of it. So much so that Microsoft had to invest about $100 million to keep it afloat. So I'm just wondering that equity, you are becoming an owner. Companies go in and out of favor, but have this exposure, keep it consistent, try and be regular investor. I don't know whether it is the most expensive time, or I'm not. We are not at Value Research Fund Advisor or our stock advisor service. Not We are not here to help you time it perfectly. A lot of you are asking that, is it good time? Warren Buffett has 20%, or this is expensive. That we want you to diversify abroad. We want you to invest a little bit in gold as well as an insurance, and be methodical about it. Keep it in such a structure that is protecting your money. If I have to really give up few percentage point returns for sake of safety, for sake of simplicity, for sake of ease, your ability to open the app at midnight and put your redemption request and get your money in 3 days time without worrying about whether the remittance has come into your bank account, I will choose that. I'm just looking at nice small gullible investor who should have this exposure to optimize their return, and that is the whole premise. Whether it is the best vehicle or this is the perfect vehicle or the most expensive, that is what we are taking all these factors into account. We are suggesting these four funds, of which looks like one is not an option anymore. Consider these, invest regularly, and because the gates are not always open, here I would suggest if you have some lump sum money, invest that as well.
This next question is from Nikhil Goswami. He says, given that my existing international funds are closed for a fresh investment and I need to add a new FOF, however, this will increase the total number of funds in my portfolio beyond my preferred limit of 5 to 7. How do I manage this trade-off between maintaining diversification?
I would like to answer him. Uh, Breach your preferred route. Have one or two more for sake of convenience.
Given the constraints, that's the next best.
Also, I will tell you, I would like to really emphasize, I have historically said that having too many funds does not necessarily add value. But having some, 5, 7, but there is no strict rule. If you have 10 funds and they're doing well, and you are getting the same exposure, make sure that your funds are good, and make sure that you have meaningful interest. Don't have 2% exposure in a fund, and so that when it does poorly, you say there's nothing meaningful. If it does well, you feel happy, but it has no impact on your portfolio. So having some few funds and having more than four, having more, ideally, when you are getting started, make sure that you have a fund for a reason. And that is what we try to do it with your portfolio builder at advisor. But if you have 7 of them, you're not going to get penalized. And I would also not urge you to scale it down unless there is a performance issue. Unless you have some need for money, you can prioritize it and sell one or two funds. But just for the sake of it, because now you have to pay the capital gains tax, and keeping it fewer funds, having a neat portfolio for the heck of it is not the goal. Optimizing performance is the goal.
Yes. In fact, the context has changed in this last few years. So one, as Dhirendra mentioned, that now there is a real cost. Till recently, selling funds after 1 year did not have cost. So you could do all the optimization without any cost implication. But now 12.5% goes away every time you sell of your capital gains. So that's a real cost. And the second is that the operational hassle that came with managing a big portfolio with too many funds or too many folios has substantially reduced with all the kind of aggregation mechanism that we have. So now aggregating all your investments neatly for a consolidated view is no longer a challenge. You can do it on the fund advisor platform very seamlessly with one OTP. So those hurdles which were a big deterrent are no longer there. And if for compulsions there is no other reason but to no other option but to have one more fund, then I think that should be more acceptable than it was earlier. Next question is from Mr. Venugopal ji. He says, can we sell or exit these recommended funds the way we can exit other India-based funds? Yes, absolutely. See, for all practical purposes, these are India-based funds. They operate, they work, you buy, you sell them.
They're regulated like that, yeah.
They are regulated within the construct of the mutual fund regulations, and they are within the purview of SEBI. So for all practical purposes, they are like domestic funds, just that the underlying investments where your money gets invested reside abroad. That's the only difference. One important distinction that you have to keep in mind, though, is that for the fund of funds, and all of them are fund of funds that we have on our list, the capital gain tax implication is slightly different because you need to hold them for at least 2 years for them to qualify for the long-term capital gain tax treatment. So when you are selling, that is the nuance that you need to be aware of, that after completing 1 year, if you sell, you would be put to a higher tax. So make sure that, look at your holding period. It has to be 2 years to qualify for, the lower capital gain tax rate. Next question is from Mr. Anjum Sheikh. He says, I'd like to invest in Southeast Asia and China index funds to diversify my investments. I'm already investing in US index funds. Should I?
Make a choice. Normally, the reason why we say that never invest in a sector fund, it is a matter of choice. These are vehicles of targeted diversification. You want to invest in China and you don't know how to go about investing. Here is a vehicle of targeted diversification. If for some reason you want it, but even when it comes to international fund, I would like you to invest. I'm basically suggesting a framework which most people should understand, is that you are gaining exposure to diversify elsewhere. We are little lenient about US domiciled fund because even though they are domiciled in the US, they are very diversified businesses. That is, we look at them as a diversified global funds, and that is the reason why you should invest in them. This is a choice which you have to make yourself based on your preferences and liking.
Abhineet Singh says, which of the suggested international funds is more global in nature? So out of the four, clearly, if you want a more global one, then the Franklin US Opportunities is the one which is relatively more focused on the US domiciled countries. But if you're looking at purely from a domicile perspective, then Kotak Global Innovation would be relatively more diversified with about 13% exposure in emerging markets and about 11% in Europe. But the idea is that you should look at it from a broader perspective, and exactly what Dhirendra was just mentioning a while back, that a lot of the businesses, the more innovative businesses like Alphabet, for instance, their businesses are very global. They might still be domiciled in the US, but when you look at where their revenue streams come from, they are practically not American companies. They are absolutely global companies. So when you strictly look at a global exposure, just have that view in mind. But purely from a country of domicile perspective, global innovation, Kotak Global Innovation FOF should be the one that tops these four, although by a slight margin. Next question is from Ramakrishna. He says, is it a good idea to move 40% PF to these funds and stay invested until next 15 years?
It's a very serious money. You are moving your provident fund money, but by all means, if you have a 15-year view, but I would suggest one thing: don't do it today, don't do it tomorrow. Do it gradually over a period of time, because when moving your large sum of money into equity from provident fund, which is substantially fixed income today, uh, our own behavior will change if we witness that this kind of money witnesses a 10% decline, and it can happen in the short run. 15 years time, I'm very confident that it will be the most rewarding vehicle for investors, because humanity improves, grows, and there has never been a 10-year, 15-year period where even domestic market has been disappointing. And here, these are the exposure to high performance companies, they change with time despite the lean period. So, yes, but you will have to do it in a manner that you don't misbehave yourself with your money and don't get nervous at the wrong time.
Jishnu K says, when I look at the portfolio of an international fund of fund on value research, it always shows underlying data is not available. Why are the underlying stocks of that fund missing? Simply because of the constraints of how much disclosures are made. So when domestic mutual funds invest in an underlying fund abroad, what they disclose on a monthly basis is only the underlying funds, and not they don't parse through and give the details at the stock level. Limited details are available in the underlying in the fact sheets of the underlying funds, but those are not available directly in a machine readable format. Although this is something we are looking at, and how we can build a pipeline of this data. While our analysts are looking at some of these funds, they do look at the fact sheets of these underlying funds. And that was a context how we could provide some context of where your money gets invested. But getting that seamlessly in a friction-free data format or a machine readable format for that to automatically populate your portfolio consistently, repeatably, over a period of time, month on month, is something which is not as easily available right now. But that's something we'll see if we can make that happen.
Okay, we got the last question. But before that, I would just like to tell you that in India, we are very lucky to have far greater transparency. For every mutual
Yes.
fund, we get the entire for every equity fund, we get the entire portfolio uh, uh, at a securities level. Uh, that is not available even for the international fund in those market itself. US funds are not mandated to disclose that detailed information on a month-on-month basis. In India, value research, in fact, it is not even law. We persuaded most fund companies to share that data, which has almost become a standard now over the last 20 years. And somebody is asking
I
that,
recall, sunlight is the best disinfectant was
yeah,
a famous quote by one of the former SEBI chiefs on this issue, and
yeah,
the industry has
we were
upheld.
interviewing him, and we got
Yeah.
this thing, this information, quite a remarkable quote. Now, Sarthak Juneja is asking that is it better to increase SIP amount per year and say
Or add,
add one fund? If your four funds you are investing in, they are good fund, invest more. If one of the fund is looking weaker, add one more.
great. So that's about it for this session. Thank you so much for joining us. And you have a to-do list. In case your entire portfolio resides in India, then we hopefully have been able to answer what you need to do on the Monday morning. And you've got a list of funds to pick one and get going. And you can do that easily on Fund Advisor app. Have a nice weekend.
What? Thank you, voter.